All right, guys, so someone asked me this question. How do you know what strike price to put, what strike price to set for your premiums that you want to collect? And this is a question from my Discord, so I'm going to kind of summarize this real quick for you. The sell price of the put is the same as the buy price of the put for your target, right? So if you are targeting, say you have a cash secured put, which I'm looking to close out right now for 10, okay? My strike price was 10. I want $1.50. So if I'm looking at when do I get $1.50, I'm looking at a 13.50, and you can look through the buy to open puts, and you just scroll through the strike prices and you go, oh, all right, 13.50. It's paying. People are pricing in at $1.50 that they're willing to pay that to buy the put. Okay, so that means the stock price has to go up to $1.50 for me to close out of my cash secured put early. I'm going to show you what this looks like. You guys are going to have to listen to my dogs, unfortunately. So equal but opposite would be the cash secured put and the put. Now, where do these things, so they are equal but opposite, meaning that, say I'm trying to, okay, I took a cash secured put, which I collected premiums on, and the stock is going like this, okay? My strike is down here, right? This is the cash secured put. It's running like this. Okay, my strike is 10, and the stock is currently trading at, say, 12, or ETF, or whatever you guys. Someone on this side of the equation is going to buy. Someone is betting that the stock is going to turn around at a certain point, and they are going to pay the premium, or they're paying it for a different reason. They could be protecting their downside as well. So maybe they have, I don't know, Google, and they have a call option that is going way up, right? And they want to put a protective put strategy, right? So they're going to buy a put to protect their call option, okay? And they are willing to pay $1.50. Okay. I want to get out of this early. Like, my expiration might be a month out. So I'm going to pre-plan this, and I'm going to say I want to buy to close my position, my $10 put, and I'm willing to pay back $1.50. This person's going to pay $1.50, which is collected at the entry point of the cash secured put. So you're looking to see where this person is paying $1.50 and where you need to be at $1.50. So this number has to represent what this person's willing to pay. So this person's willing to pay $1.50 at a 13.50 strike. Okay, so you're going to forward look and look at this options chain to see what your price would have to be in order to get your buy to close. Okay, now when I took this, okay, I might have collected, say, $2.50, right? So I'm capturing $1 in profit, and I'm willing to let it go for $1.50 because I'm still gonna capture the difference between this. I just want to close early, so I'm gonna give it up. These guys are willing to say, hey, look, I'm gonna put up $1.50 to buy the put at 13.50. Because that's where they're pricing in. So I just need this to go to 13.50. meaning that these are kind of equal but opposites. You're playing, if you're on the cash secured put side or the buy put side, you might be using this as a protective strategy. If you're on the cash secured put side, you're just going to look at the buy puts side to see where you need to be in order to even out this leverage, right? Because basically your trading is going like this, right? And you want to try to smooth it out. That's all you're trying to do. The other, and markets are cyclical, right? So if this is the market, so it's spinning around in a giant circle, and you're on the inside, your trading platform is on the inside. It's a terrible circle. Your variation is between here. So maybe this is 30%, right? This is your high income dividends ETFs, and you're trying to smooth out this ride in between here. If you go too far in the middle, you lose everything. Okay, so you want to stay on the outskirts, but you're just trying to smooth out the ride, right? Sometimes you go way over, right? But then the crash comes more. It's like a sunflower, right? You get these wild swings. You want to try to, and because it's, this is December, January, February. Assume this is, the clock of the year, right? The sundial. You're trying to just smooth out these rides with options, and you got to find like a nice happy medium, right? People make money way out here, people make money way in here. But when you're doing the cash secured put and the covered call, you are looking for this nice juicy area that's full of premiums, right? That's consistent. You don't get caught. You don't get caught down here. You don't get caught out here. You're just looking for a smooth ride. It's going to pay you a nice premium. And why did I want to show you this? Because I just had a week where I've been crushing it. These past, this quarter, I've been crushing it, right? And I just had a week where I had to pay a lot of money. I'm kind of in this weird interim on this. I had to pay something assume that I got $250, I had to pay $2, right? So on the capture the 50, I had to pay a lot of money. So now I'm just in this weird waiting period. So if you were to break these up into weeks, 52 weeks, you might be super green like I was, and then just have a really small green. I'm even gonna put it down here. I had a really small green. I've been averaging 4,000 a week, and then I only did $100 this past week. Okay, because I had taken the trade wrong. So we're just trying to smooth this out. That's all I'm trying to show you guys. That's why I showed you guys this. Okay, you want to try to smooth out this area by being consistent, taking the trades correctly. This is the sweet spot. You don't need to be. It doesn't need to be crazy. Nothing like that.